Good morning, traders. It's 8:01 a.m. Chicago time on Thursday, the 27th of February, 2020. Hopefully, I'm not coming across too loud. I believe I checked yesterday's video and it seemed like I was really loud. Anyway, this is episode number 1701. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, risk off continues as the market tested, the S&P tested the sell-off day's low and attempted to bounce higher and closed weak. And with the point of control near the low of the range, overall the market's not finding the buyers it's looking for so far. There's no traction, and this issue with the coronavirus continues to be in the forefront as many agencies, governments say it's not a big deal, it's not an issue, and I think the ECB just released a comment about how they're not seeing the point in accommodating or changing anything based on the coronavirus, which I think will probably be something else. The WHO will hold a press conference coronavirus here in, actually it started already about 15 minutes ago to inform the public on where we are. But the market's got jitters here. The market also has some structural issues, I think, macro-based issues based on the information I heard from a guest on Macro Voices, the podcast, which I recommend to everybody to listen to just to get a big picture view on things. In any case, the euro is higher, and gold is higher. Gold is trading up $11.40 at 1654.50. Crude oil's off. Crude oil's way off today. April crude is trading at 46.85, down 1.88%, 3.86%, down $1.88 after yesterday's inventories. The Euro stocks are the weakest index that I monitor. 124 points. That is very, very high in terms of a loss. The DAX is off 3.25% this morning. This morning we did get, the eurozone business confidence wasn't as bad as forecast. Came in at 0.04, negative 0.04 versus negative 0.27. GDP. What's going on here? U.S. GDP was released, came in line 2.1%. Durable goods orders came in a lot better than expected. Expected at negative 2%, came in at negative 0.2%. This evening we have the GfK consumer confidence out of Great Britain at 7:01 p.m. Eastern time, expecting -8. We do have multiple speakers today. Pending home sales at 10 o'clock Eastern. We have an ECB speaker at 11, Feds Evans at 11:30, and Mester at 3:30 Eastern time. So that's what's on schedule. In terms of trading itself, let's take a look at what was expected yesterday. Yesterday, I made an argument based on what I anticipated to be fact for a push higher on the open. The expectation or a push higher. I expected the sellers to rest yesterday, and I expected a push into 31.76, as you see here. 31.76 on both scenarios. The first scenario expected to be a drift, an open auction, a drift, because we're opening in the high volume node or point of control zone. Expected that to be a drift, find a base, push higher into 76, and that's the extent of it. I expected yesterday to be an inside day or rest day. I did talk about the high probability that we would test 31.17 and maybe pop back up. Here's the interesting thing. Scenario 2 happened. We tested 76 and turned down. Scenario 1 happened in that we did test below the prior low at 17.25. We did pop to 76. But really, scenario three happened in that it drove down, pushed down, way down lower, and it's continuing to do so. Here's what actually happened yesterday. Let's crunch this down so it can fit in your charts. Clean this up. So this is the 76 area. The next area up I outlined, if you recall, right up here, I outlined 82 and 80 and 92 above. So so 76 is the initial test, pulls back, looks like scenario two, looks like scenario two full on. This push up here is scenario one. Remember, I cautioned that breakout traders, breakout sellers yesterday are likely to feel some pain, and that's really what I anticipated here on a push up. And where does it go? It goes 3 ticks ahead of the 76 expected, rotates back down into the range, and then pushes into 82, which is the next area up, and above that was 92. And then we get this big selling spree, which tells me, hey, that low is vulnerable, so look for an area to get short, looking for a mid pullback on the drop. The mid of the drop is actually right here for the continuation, and we do get that. We do see that, and then from there, the market goes into a sideways drift where we end up moving the point of control. The point of control to the low end of the range below the IB on a neutral day. And what we finished with yesterday, and this is the important thing, is we finished with a neutral extreme down day, on a sell-off. This is a big, big problem for longs when this happens. The market essentially tested higher yesterday. It made a valiant attempt on high volume to push higher. It made another attempt to continue and failed to do so. As soon as we saw that we had an impulse down, all longs are off the table. Risk is too high for the longs. Risk now is being on the long side, which means that better opportunity of gain is likely, or an asymmetrical risk is likely existing in the short side. And so the job then, it becomes use your moving averages, your RSIs or CCIs, your whatever you want to use, fibs and whatnot, to look at your setups, predefined setups, hopefully to the short side only at this point. So from this point forward, it's look to the short side, and then when we finish on a neutral extreme, any longs into the close are likely to get squished because the auction tested higher, broke the IB high, could not hold, broke the IB low, so this is neutral. If it had finished neutral, neutral in the middle, normal neutral, then I would say pretty good bet that it's likely to push 82 into 92. But what we did is we finished neutral extreme down. So we poked through the roof here to see if there's anything there. Okay, anybody who is looking to get short can now confidently get short because there's no interest. There's no buying interest. We saw selling interest come in. Saw interest come in to sell, and then it rotated through, and so now the follow through is expected on the impulse day down. So let's look at this in the big picture so we can see. Consider that. What would you do if this was, if those of you who have been listening for a while, what would you do if this was an intraday chart? All of this happened in an intraday move, say at the open, right? An open auction here and a gap. This is an open auction and a gap. The opening swing is the high and the low of this day or whatever, and then you have an impulsive move down. You would look for a mid pullback or so, something to lean against, in this case 76, 82, 92. and then you would look for the continuation, right? So yesterday had a little had a continuation move, but the continuation was cut off by the pit, or the RTH session ending, and so it's incomplete. I hate to sound like a football referee here, but it's incomplete, and then we get this kind of continuation move here today. So the impulse, the real impulse, is the overnight sell-off. Um, the overnight sell-off on that gap down, and then what we're getting today. One second, let me see what this news is. Um, so we would get the continuation move here, and what we're setting up for now in the overnight session is, okay, we have a new impulse based on yesterday's action. We have a pullback, and this is likely to see a continuation again. Um, this is really this is really a tough place to be if you're long, or if you're short puts or something. You know, likely to be assigned here depending on what we do over the next few. But so that's where we stand in terms of the narrative and where we are today. The overnight session had heavy volume, is having heavy volume. Already breaching 1 million contracts overnight. This is about 10 times the volume, and is showing that it cannot hang on. It just cannot hang on to higher prices on the retest. It's just showing weakness again and again and again. In my opinion, the odds are leaning back towards the short side. It's kind of obvious. I'm stating the obvious here, probably. I can show you what's going on in the order flow, but I've got to tell you, there's not much point to it. The book is very thin on the inside, still 100 lots, steady up and down. And as you come into the inside market, we have 20 and 30 lots, which is quite thin for this product. We expect about 100, 150 on the inside, 200 to 300 up and down. And what we're doing now on the order flow is we're colliding with a lot of volume. You could see these big collisions taking place where we have some liquidity, we collide, we push through, and then we bounce. Some liquidity, we collide. You can see that big dot. We're trying to bounce here, and we have a lot of liquidity below us. Remember yesterday, there was liquidity above, and we pushed higher, and so we have this liquidity below us, and we're likely to just continue to grind through. This is 3050. It's a mid-century strike, so we do expect some liquidity around there, and much of the book is skewed to the buy side, as you can see by this indicator here. It's skewed quite heavily to the buy side, which tells me that there are quite a few bids down below, which is likely to have us see a market go in that direction. Remember, the third force, which is the side that has not bought and has not sold, and we don't know what it is. We can quantify what is bought or sold. We can quantify that. Your charts will show you that. If you have good, accurate tick data, you'll be able to see who bought, how many bought, how many sold, at what prices. The third force is that thing, the millions and millions and millions and millions of contracts that are sitting on the sidelines that we know nothing about. And generally, when people enter the market, there's very often the use of market orders, but the exits are generally out there in terms of limit orders, and that's what we're seeing here. And that's my reasoning, nobody else's. This is my reasoning as to why the market tends to move towards size, is because the market's already moving and the smart money is already positioned to take advantage of that momentum. Geez, there's a lot of news. Is positioned to take advantage of that momentum, and so we see what is bid, but we don't see what's at market, and so that's kind of my explanation. Anyway, probably didn't need to hear that. But it's just important to understand what that liquidity means and why I believe the market tends to skew to that liquidity. It's not because the liquidity is there and it attracts the market, and that could be a reason. If I had big size to fill, then I would continue to fill into that size because then I can get an efficient VWAP on my fill order. If there's size there and I want to sell, I'm going to continue to sell until it pushes into this size. I can quantify my slippage in this scenario. That may be a reason for that, but generally I believe that those who are short from somewhere, and they're bidding out their exits, whatever that is, if they are in this time frame, or if they're in a much higher time frame, which is more likely, they're working their target on their program, and we get to see that target on the heat map, which is the only place we get to see it. This is why CT Bookmap is a favorite of mine. Anyway, so let's get back to our trading here. What are we expecting for today? Look, I could sit here and draw whatever scenarios. And the fact is, the market is in a bit of a panic, and it doesn't really matter. I don't have a reason as to why I think a certain scenario is going to play over another, other than the behavior of the auction. And so I'm seeing that the auction, as I said from the overnight session, I'm seeing that the auction is not able to find buyers. So we'll continue to sell for this purpose of finding buyers. That's what we're looking for when we're selling. We're not selling so we can sell lower prices. We are selling so we can advertise the S&P 500 and its glory as cheap enough for buyers to come in. Is this, will you buy me at 30, 100? Will you? No. Well, will you buy me at 30.90? No. Will you buy me at 80? What about 60? What about 50? What about 40? Oh, you're buying me at 40. Okay, now I don't need to reduce my price to 30. I can now raise my price to 50 again and 60 again and so on. And then, oh, nobody wants to keep buying at 60 or 70. Then how about 50? Can you take my stuff off my inventory off of me at 50? Okay, somebody's willing to take my inventory off at 50. Okay, we've now achieved balance. Now we've got people willing to trade, and they believe 30.50, for example, as a hypothetical. 30.50 is the place where balance is. Now the market has done its job, and now it can efficiently transact as much volume as possible, which is the point of a marketplace. The point of a grocery store is to get as much of their inventory sold as possible to as many people as possible. And the reason you go to the supermarket versus the farmer is because you want to find efficient, competitive prices, of course, convenience and so on, to buy your stuff. What you don't want to do is go from this store to that store to that store to compare apples. You expect that the market has already done that for you, and that then you can transact freely and abundantly without having to worry about waiting longer and so on. That's the point of the market. Let's not forget that. So sitting here and drawing lines and saying it's going to do this and then it's going to go up and it's going to go down, and it's going to go over here, kind of pointless here because the market's not finding efficiency yet. So not trying to avoid it, but the fact is below here, there's looking at the profile down here, it's really difficult to see where this is likely to find some traction. We do have an MC point of control at 30.43 from way back. That's a balance area that the market may respect. Don't know. You could see the volume, a little bit of volume here, and then you could see us coming into a little bit of balance down in the 3,000 area, and that may be the area. That may be the area that the market may stabilize, and buyers can now feel more confident coming in. But yesterday's action was down with a delta down. Buyers tried early on, and they unsuccessfully attempted a push higher, and they successfully found their sellers in the 3182 area. And then once they successfully did that, everybody just puked and turned over and sold. And that's where we are. So I'm not going to do any scenarios. I'm not trading with scenarios. I would say if you're trading a small account, please step back. Please don't trade this stuff. It's not really worth it. And we're pushing into a pretty interesting region here. We're trading on top of the 61.8% fib retracement of the last major swing from the low to the all-time high on an RTH basis. This is a day session only basis. So we are pushing into that. It's kind of holding steady here at 62.50. And the 200 SMA is at 3051. 3051, that's this line. Again, it's an SMA. It's on RTH only. Is there a reason the market should stop there? I have no clue. I'm a volume profile kind of structure guy, so I don't really know. But just be aware of those big landmarks. I'll leave you with that. Be careful and just step back. Trade if you have less than full initial margin, full initial exchange margin in your account for your product. Please step back. The volatility is too high for you to keep the percent at risk per trade low enough to avoid a high risk of ruin. If you're sitting here betting 20% of your account on your stop because it has to be really wide now, on every trade, your risk of ruin is very, very high. It just means that you have about 8 or 9 trades before your limit down. So if you have full margin, potentially, so I suggest that you can potentially survive that. That's how it's kind of designed. So I would advise you to just sit this one out until the market stabilizes. Of course, if you're trading the mini indices, please move down to the micros and make sure you still have full margin there. Do not do the $300 per contract ES garbage that some people may offer. It's not designed to keep you alive. It's designed to make you trade. And the same for micros. $30 micros, $30 margin micros. It's to me it seems irresponsible. So I suggest you just look at full margin per contract. I know I said that a lot of times. I just want you to be here tomorrow and the day after. Good luck.